Welcome, curious explorers, to the deep dive. Today, we're embarking on an expedition that might just, well, redefine how you see the financial markets. Imagine you heard whispers of these hidden treasures, secret maps to things called anomalies, patterns that promise to beat the odds and, unlock predictable returns in the seemingly unpredictable world of stocks. But what if, after years of people searching, most of those maps turn out to be misleading? Or the treasure chests, when you finally pry them open, are actually pretty much empty.
Yeah, that's a pretty good way to put it.
That's really the provocative question at the heart of this groundbreaking study we're diving into today, Replicating Anomalies by Hu, Zhu, and Zhang, published in 2020. It's this formidable paper that systematically reevaluates hundreds of these so-called market secrets, and it challenges decades of, accumulated wisdom and long-held beliefs about how efficient markets really are.
It really does shake things up.
So our mission today is clear. We're going to unpack their monumental findings, try to understand the meticulous methodology they used, and reveal which of these market secrets truly stand strong under, the most intense scrutiny. And maybe, more importantly, we'll discover why so many others just crumble. Prepare to learn that capital markets might be far more efficient than we previously acknowledged, meaning those easy wins you might have heard about are likely much, much harder to find than you ever imagined. All right, let's unpack this fascinating puzzle. When we talk about financial anomalies, what exactly are we referring to in the context of the stock market? Like, what did people think they'd found?
Well, think of financial anomalies as perceived glitches in the system, maybe.
Yeah.
They're patterns or specific strategies that appear to offer abnormal returns, returns better than you'd expect given the risk. And this seems to defy the whole idea of market efficiency. The efficient market hypothesis fundamentally suggests all the public information is already baked into stock prices, making it, theoretically impossible to consistently beat the market.
Right, the no free lunch idea.
Exactly. But anomalies, they propose these predictable movements or mispricings that a clever investor could theoretically exploit. So examples range from things like how a stock's past price performance might predict its future, that's momentum, or maybe specific accounting ratios like how cheap a stock looks compared to its book value might signal future outperformance. These were supposed to be the cheat codes to market success, if you like.
Okay, so these are the treasure maps people genuinely believed would lead them to easy gold. But this study, it reveals a pretty harsh reality for most of them, doesn't it? It's not just a few that failed. It's like a huge proportion.
Precisely. The core finding is quite stark, really. When these anomalies are put through a much stricter, more realistic empirical gauntlet, most of them just don't hold up. I mean, to give you a sense of the scale, out of 452 anomalies they documented in their huge data library, basically, this massive collection of treasure maps, a staggering 65%, couldn't even meet a basic statistical hurdle for significance. That's, nearly 2/3 right off the bat?
65%,
Yeah.
Wow.
Yeah. And if you apply an even more rigorous standard, something called multiple testing, which basically accounts for the fact that researchers are digging through hundreds of possibilities, increasing the odds of finding false positives just by chance.
Right, like finding a pattern in random noise if you look hard enough.
Exactly. Well, with that standard, the failure rate jumps to an alarming 82%. Think about that. For every 5 anomalies ever reported, roughly 4 of them don't stand up to this kind of intense scrutiny. It's like finding 4 out of 5 maps just point to, nothing. And here's another crucial bit. Even for the small percentage that do replicate, their economic magnitudes, meaning the actual profits you could realistically make, are consistently much smaller than what was claimed in the original studies.
That's just astonishing. It's almost unsettling to think that so many findings, published findings, could be, not true when you re-examine them rigorously. But you mentioned this isn't just a finance-specific thing. It's part of a bigger trend in science.
That's right, and it's a really fascinating connection. This study in finance, it actually contributes to a much larger sort of global phenomenon, often called the reproducibility crisis. It's being observed across loads of scientific disciplines. There was this highly influential paper back in 2005 by Ioannidis who argued quite provocatively that most research findings are false for most designs in most fields. And the evidence since then has only kind of reinforced that concern.
Most findings are false. That's a huge claim.
It is, but we've seen this play out in fields really far removed from finance. Like in oncology, scientists at Bayer tried to reproduce 67 published studies and failed to replicate two-thirds of them.
Two-thirds.
Yeah. And similarly, in drug development, researchers at Amgen attempted to replicate 53 landmark studies and could only reproduce the original results in just 6 cases. 6 out of 53. Psychology's had its own reckoning, too. In 2015, the Open Science Collaboration tried replicating 100 studies from top journals, and they found a success rate of only 36%. And maybe most tellingly, a 2016 Nature survey. It polled over 1,500 scientists. More than 70% said they'd failed to reproduce other scientists' experiments, and over 50% admitted they couldn't even reproduce their own work consistently.
Their own work.
Right.
That's quite something. So, okay, if this is such a widespread problem, what makes finance particularly vulnerable to these false positives or findings that just don't hold up? Are there unique challenges here?
That's a really important question, and it seems to be a confluence of several factors that often interact. One really significant culprit is what we call data mining, or maybe more informally, packing.
Hacking, I've heard that term.
Yeah. Imagine a researcher digging through this enormous pile of data, right, looking for a specific pattern. They're under pressure often to find novel and statistically significant results. So they might inadvertently, or sometimes, let's be honest, intentionally try different ways to define variables, look at different time periods, use slightly different statistical tests until, boom, an insignificant result suddenly looks significant.
So it's like torturing the data until it confesses.
Kind of, yeah. It's like searching for a specific constellation, and if you stare long enough, maybe you convince yourself you found a pattern that isn't really there. Lowe and McKinley showed way back in 1990 how this problem gets worse the more studies are done on the same data set. And we've seen hints of this before in finance. Framman noted in '98 that anomalies often weaken or just disappear when you use value-weighted returns, which are more realistic for big investors. Schwert observed in 2003 that patterns sometimes vanish right after they're published. And more recently, McLean and Pontiff confirmed in 2016 that the average returns from loads of anomalies declined significantly after they were published.
Suggesting maybe they weren't that robust to begin with, or people started trading them away.
Both are possible, yeah. Then you've got significant publication biases. Top academic journals, they have a strong preference for publishing novel, statistically significant findings. It's incredibly difficult to get a non-result published, a study that just says, hey, we looked for this effect and it's not there.
Right, it's not as exciting.
Exactly. And unlike some other fields, finance journals have historically been, well, pretty reluctant to publish straightforward replication studies just focused on verifying existing findings. This creates this powerful incentive for academics to constantly chase the new significant result rather than rigorously checking the old ones. It skews the whole landscape towards novelty over robustness.
So the system itself encourages finding something, even if it's fragile.
To some extent, yes. And Harvey highlighted what he called an agency problem in 2017. Journal editors, they compete for higher citation rates, which often means preferring papers with really significant eye-catching results. This puts pressure back on the authors who might then, quietly file away weak results or engage in intensive specification searching.
Which is just trying lots of models until one works.
Pretty much, yeah. Trying out many different ways to model the data until they hit that significant finding. And Harvey said this can lead to an embarrassingly large number of false positives.
Embarrassingly large. Okay.
Another critical factor, I think, is the lack of strong economic theory underpinning much of the anomalies literature. It's often heavily empirical. Researchers start with the data, look for patterns, rather than starting with a clear economic hypothesis about why something should predict returns. After the capital asset pricing model, a really foundational theory, faced challenges, empiricists felt sort of free to explore hundreds of variables with little a priori hypothesizing. Ioannidis warns results are more likely to be false when you have many but fewer theoretically predicted relations.
So if you're just pattern searching without a strong why, you're more likely to find fool's gold.
That's a good way to think about it. If we connect this to the bigger picture, the credibility of this whole field would improve massively with a closer connection to robust economic theory, moving beyond just statistical correlations to explanations grounded in, fundamental economics.
Makes sense.
And finally, we just cannot ignore the sheer financial interests involved. I mean, there are trillions of dollars invested globally in factors-based ETFs and quant hedge funds. The financial incentive to find and publish new anomalies is simply overwhelming. You've got armies of academics, armies of investment managers, all actively searching for these significant anomalies, each hoping to get an edge. And this intense competition, unfortunately, can just exacerbate the issues of data mining and publication bias. It creates this powerful feedback loop.
Okay, so against this backdrop of, frankly, widespread skepticism and this scientific reproducibility crisis, how did Hao, Zhu, and Zhang actually go about tackling this massive undertaking in finance? What was their deep dive mission, and how did they aim to bring some genuine clarity to this, well, crowded and often confusing field?
Well, their primary purpose was straightforward but really ambitious. Simply to establish the correctness of a previous study. They adopted a definition of replication similar to one emphasized by the American Economic Review back in 2017. Basically, any study whose main goal is to determine the validity of one or more empirical results from a previously published study. So this wasn't about discovering new market secrets. It was all about rigorously retesting the existing ones under the toughest possible conditions they could devise.
Right, verification, not discovery.
Exactly. And the sheer scope of their work is truly impressive. They compiled this extensive data library covering the vast majority of published finance and accounting anomalies, a colossal 452 variables. These were meticulously organized into 6 key categories. Momentum, that had 57 anomalies, value versus growth with 69, investment 38, profitability 79, intangibles, a big one with 103, and trading frictions, another large one with 106.
Wow, 452, that's a lot.
It's huge. And their data span this really extensive period from January 1967 all the way through December 2016, nearly 50 years. This long window allowed them to assess the consistency and durability of these patterns over all sorts of different market cycles.
Okay, so this sounds incredibly meticulous, almost like a forensic accounting of the entire field. What specific steps did they take to ensure their replications were reliable and didn't just, rerun potentially flawed code or methods from the original studies?
You're right, it was meticulous. They employed what Hammermesh called scientific replication. This is a crucial approach, especially for observational fields like economics, finance, and accounting, where you can't just perfectly recreate lab experiments. So instead of just rerunning the exact same code, scientific replication often involves using the same population concept, but maybe slightly different samples, and importantly, similar but not identical methods.
Similar but not identical. Why is that better?
Because it tests whether the findings hold up not just under the exact original conditions, but under slightly varied yet still perfectly valid specifications. It makes the results much more robust if they survive that. It shows the finding isn't just an artifact of one very specific way of doing things. So they closely follow the original variable definitions, but sometimes they introduced what they called small perturbations, minor sensible adjustments to really evaluate the reliability of an anomaly's predictive power. For instance, for anomalies sorted monthly, they tested 3 different predictive horizons: 1 month, 6 months, and 12 months. This recognizes that an effect might be really short-lived, or maybe it only shows up over a longer period. It gives a much more comprehensive picture.
Okay, that makes sense, covering different time frames.
Yeah, their data came from standard industry sources, CRSP for monthly returns, Compustat for accounting info. And importantly, while they did exclude financial firms and firms with negative book equity, which is pretty standard, they did include microcaps in their sample. And this is a super crucial point we need to dig into because these tiny stocks have a huge, often really distorting impact on results.
Right, the microcaps. We'll definitely get to them. But first, here's where it gets really interesting, I think. For anyone trying to understand what actually works in the market, this study highlights specific procedures they considered more reliable for testing these anomalies. Can you explain what these are and why they matter so much for getting a true, maybe even investable picture?
Absolutely. This is key. They emphasized methods that deliberately control for that outsized, often misleading influence of tiny stocks, the microcaps, and instead try to reflect what real-world institutional investors actually experience. So for portfolio sorts, their kind of gold standard method involved using NYSE breakpoints and value-weighted returns. Let's call it NYSE VW. They considered an anomaly genuinely replicated if its high minus low decile average return was statistically significant using this method.
Okay, NYSE breakpoints and value-weighted. Why those specifically?
Great question. 2 main reasons. First, Value weighting is critical because it accurately reflects the wealth effect experienced by investors, as Nobel laureate Eugene Fama pointed out. It gives more weight to larger, more liquid stocks, the ones that make up most of the market value. It's what large institutional investors actually hold and experience in their portfolios.
Not giving tiny stocks the same vote as giants.
Precisely. Second, using NYSE breakpoints is crucial. When you form portfolios, like ranking stocks into 10 groups, deciles, using only NYSE stocks to set the size boundaries ensures that the portfolios you build contain a fairer representation of both small and big stocks, especially in the extreme top and bottom deciles. It prevents those numerous tiny microcaps from completely dominating the extreme portfolios, which can artificially inflate anomaly returns if you use broader breakpoints like NYSE, Amex, NASDAQ.
Got it. Controls the influence of the small guys. What about regressions?
Yeah, for cross-sectional regressions, their preferred method was weighted least squares, FMWLS, with market equity as weights. Again, an anomalies effect was considered replicated if its slope coefficient was statistically significant using this method.
And why weighted least squares? Weighted by market cap.
Same logic, really. It effectively mitigates the impact of microcaps. Standard ordinary least squares, OLS regressions, can be dominated by microcaps because of their plentifulness, as the authors put it. OLS is also disproportionately sensitive to outliers, and microcaps, with their wild, volatile returns, often are the outliers.
Right.
By weighting the regression by market equity, FMWLS ensures that larger, more economically important stocks have a greater influence on the results. It gives you a more realistic picture of the market-wide relationship, as Harvey and Liu also argued.
Okay, that seems really sensible. Weight things by how much they actually matter in the market.
Exactly. And one final point on their method. They made a deliberate and, I think, powerful choice to stick mainly to univariate regressions, meaning they looked at one anomaly variable at a time, predicting returns.
Instead of throwing lots of variables into one big model.
Right. They did that to avoid the excessive flexibility of multivariate regressions, where researchers might keep adding or removing control variables until they happen to achieve a statistically significant result for the variable they're interested in. This specification search, or p-hacking, is a well-known pitfall. By keeping it simple, testing one thing at a time cleanly, they aim to minimize those potential traps and ensure any significance they found was more likely to be genuine.
Okay, you've mentioned microcaps multiple times now as this critical, almost villainous factor in understanding why so many anomalies seem to just disappear under scrutiny. What exactly are these microcaps, and why do they wield such disproportionate power in academic finance research?
The microcaps. Yes, they are a crucial piece of this whole puzzle. In this study, they define them pretty standardly. Stocks that are smaller than the 20th percentile of market equity for NYSE stocks. So the smallest fifth of companies listed on the New York Stock Exchange, basically. Now imagine a bustling stock market conference, right? Microcaps are like this vast crowd of very small, often very loud attendees. They are astonishingly numerous, but collectively they hold very little economic sway.
Lots of them, but not much total value.
Exactly. Their disproportionate influence stems from two key things: their numerical dominance and their tiny market share. Get this. Microcaps represent an astonishing 60.7% of the total number of firms in the study's sample. That's roughly 2,365 out of an average of 3,896 firms. They are literally everywhere in the data.
Over 60% are microcaps.
Yeah. However, despite these overwhelming numbers, they collectively account for only a paltry 3.21% of the total market capitalization, just over 3%. Compare that to big stocks, the largest ones, which make up over 90% of the market cap, but are far fewer in number.
That's a massive difference. So most firms are tiny, but most money's in the big ones.
Precisely. And what's more, microcaps tend to have the highest average equal-weighted returns, maybe 1.27% per month, compared to 1.01% for big stocks in their sample. But, and this is key, they also have the highest cross-sectional standard deviations of monthly returns, a staggering 19.26% versus maybe 8.84% for big stocks.
Meaning their returns are all over the place, much more unpredictable.
Exactly. They're not just volatile individually, but their returns are wildly dispersed from each other. They're prone to extreme swings, weird statistical quirks. This makes them prime candidates for generating statistical noise that can accidentally look like a significant anomaly pattern, especially if you're not careful about how you weight them.
Okay, so it's like this huge chorus of very small, very unpredictable voices singing really loudly, and it can make it sound like the entire market is singing a certain tune, even if the main acts on stage, the big companies, are performing something totally different. How did the original studies end up giving these microcaps such an outsized, often misleading role?
That's an excellent analogy. Yeah, many original studies made methodological choices that perhaps inadvertently ended up overweighting these microcaps. A really common practice was using equal weighted returns in portfolio sorts.
Equal weighted, meaning every stock gets the same vote, regardless of size.
Exactly. When calculating the return of a portfolio, each stock, whether it's Apple or some tiny $10 million company, gets the exact same weight. Because microcaps are so incredibly numerous, this method inherently assigns them maximum influence. Their sheer quantity can drag the average portfolio return in their direction, even if they represent almost no investable capital for a large fund.
Okay, so just by being numerous, they skewed the average.
Right. Additionally, many studies used NYS Amex NASDAQ breakpoints instead of just the stricter NYSE breakpoints when forming those portfolios. When you cast that wider net for setting the size boundaries, microcaps can end up making up over 60% of the stocks in the extreme deciles, the highest and lowest ranked groups.
Even more concentrated in the extremes.
Yeah. And when you combine that with equal weighted returns, it just dramatically inflates the reported magnitudes of anomalies. Finally, standard ordinary least squares OLS regressions also tend to assign effectively maximum weights to microcaps because OLS models try to minimize squared errors and are highly sensitive to outliers. And microcaps, with their volatile returns and often extreme characteristics, frequently are those outliers, potentially distorting the regression results.
Okay, so multiple methodological choices could unintentionally amplify the noise from these tiny stocks. So what does this actually mean for an investor, say a fund manager or even a serious individual investor who might read about an anomaly and think, hey, I can use this? If that statistical pattern is mostly driven by microcaps, what's the practical reality of trying to turn that into profit?
Yeah, this is where the rubber meets the road. If we connect this back to the bigger picture, anomalies that are primarily driven by microcaps are often, well, illusionary from a practical investment management perspective. The study illustrates this really vividly using a concept they call investment capacity.
Investment capacity.
Yeah, they basically calculated how much money could realistically be invested in portfolios built on these anomalies using different methodologies. And the difference is just stark. Consider this. With their preferred, robust method NYSE breakpoints and value-weighted returns, the investment capacity for, say, a low decile momentum portfolio might be massive, maybe around $1.2 trillion, representing nearly 6% of the aggregate market cap. That's a genuinely investable amount for large institutions.
Okay, huge capacity.
But if you use those older, less robust procedures that heavily overweight microcaps like NYSE, Amex, NASDAQ, breakpoints, and equal weighted returns, that same portfolio might only have an investment capacity of maybe $1.19 billion. That's a tiny 0.02% of the aggregate market cap.
Billion sounds like a lot, but compared to trillion.
Exactly. For a large institutional investor managing trillions, $1.19 billion is virtually nothing. It's just not scalable. You can't put serious money to work using that strategy.
And what about costs? Are microcaps easy to trade?
That's the other major problem. Microcaps typically have much higher transaction costs because they're less liquid. Imagine trying to buy or sell a large block of shares in some tiny, thinly traded company. You'd likely move the market price against yourself significantly just by trying to trade. This eats away any potential profits. It makes anomalies based primarily on microcaps incredibly difficult and expensive to actually exploit in practice, as others like Novimarks and Velikov have shown. So even if statistical pattern technically exists in the data, the real-world costs and the practical limitations often make it unfeasible to invest in.
Okay, so in essence, these microcap-driven anomalies are like whispers of buried treasure, but the treasure is hidden in this tiny, unreachable cave. It might theoretically be there, but it's either too small to be worth the effort for a big player, or it's practically impossible to extract because of the high cost and logistical nightmare of trading these illiquid stocks. But this isn't to say microcaps aren't important in the broader economy, right? We should probably clarify that. It's not like small companies don't matter.
Oh, absolutely. That's a crucial distinction to make. The study is very clear. While microcaps often distort financial anomaly research focused on investable strategies in public markets, these smaller firms play a vital role in the real economy. I mean, if you look at data from, say, the U.S. Small Business Administration or the Census Bureau, firms with fewer than 50 employees contribute over 30% of total employment. And most of those aren't even publicly traded companies found in these financial data sets.
Right, the backbone of the economy in many ways.
Exactly. And historically, these smaller firms have been significant drivers of aggregate employment growth, as researchers like Birch documented way back, and Moscarini and Postolvine more recently. They contribute to economic growth more generally. Although it's also worth noting that the financial data sets researchers typically use, like Compustat, are often quite biased against the smallest firms. The average employment size in Compustat might be thousands of employees, whereas the average across all U.S. businesses, according to census data, is closer to just 19 employees.
Huge difference.
Yeah. So the key takeaway here is really nuanced. While microcaps are absolutely indispensable for job creation and growth in the real world, their outsized and often distorting influence in academic finance studies can severely skew our understanding of true market anomalies and, more importantly, skew our view of actual investable strategies for the broader value-weighted market.
All right, so with all that meticulous methodology in mind, focusing on these robust procedures, carefully controlling for that microcap influence, rigorously retesting everything, what did the big picture actually look like? When Hu, Zhu, and Zhang applied their stringent methods, how many of those 452 supposed market anomalies actually held up?
Well, the big picture truly paints a portrait of a much, much more efficient market than many previous studies had led us to believe. When they applied their preferred robust procedure specifically, using those NYSE breakpoints and value-weighted returns for the portfolio, sorts a really striking 65% of the anomalies failed, even a single statistical significance test.
65% failed. This didn't show a reliable pattern.
Basically, yeah. And remember that multiple testing adjustment we talked about? Accounting for the fact they tested so many things. When they applied that more realistic hurdle, the failure rate for these portfolio sorts rose even higher, to a daunting 82%.
Wow, 82%.
Yeah, and for the cross-sectional regressions, using their preferred weighted least squares method, the failure rates were similarly high. It was 66.4% failure for the single test and a staggering 86.7% failure when adjusted for multiple testing. These numbers are a powerful testament, really, to just how fragile and statistically fleeting many of these supposed market-beating strategies actually turned out to be under this intense scrutiny.
And it wasn't just about statistical significance, right? You mentioned the actual returns were smaller, too.
Exactly. It wasn't just about whether they were statistically significant, it was also about their practical impact. Even for the minority of anomalies that did manage to replicate successfully, their economic magnitudes, the average returns they could actually generate, were consistently much smaller than originally reported. So even the survivors offered significantly less profit potential than the initial claims suggested. The treasure chests weren't just hard to find, they were also less full than advertised. And applying that multiple testing framework, which Harvey, Liu, and Zhu strongly advocated for, it just dramatically reduces these replication rates, confirming those widespread suspicions about an abundance of false discoveries in the literature.
That's a profound finding. Now, some might argue maybe that the study's extended sample period, going all the way to 2016, could have caused some of these anomalies to simply disappear over time. Maybe they worked once, but the market adapted. Is that what happened here?
That's a very natural question, a good counterargument to consider. But the study actually addresses it head on. They found that this widespread failure is not primarily due to their extended sample period. They meticulously repeated their tests using the shorter sample periods that were originally used in the individual studies that first reported these anomalies. And what they found was quantitatively similar results.
Really? The failure rate was similar even in the original time periods?
Yeah. For instance, the failure rate for the single test using their robust NYSE VW method in the original samples was 65.3%. That's almost identical to the 65% they found in their full extended samples. This strongly indicates that sampling variation just changes over time played a pretty limited role. It suggests the fundamental issues were rooted in the methodologies themselves, particularly the handling of microcaps and the statistical hurdle, not just in the passage of time making anomalies disappear.
Okay, that's crucial. It wasn't just that the anomalies decayed over time. So flipping that around, if microcaps were such a huge factor in inflating the original results, did letting them run wild with those older, less robust methods actually help more anomalies replicate in this study? Did using the wrong methods revive some of them?
That's an insightful question, and the answer is, well, not as much as you might think. Even when they deliberately use procedures that heavily overweight microcaps, like those broader NYSE Amex NASDAQ breakpoints combined with equal weighted returns, or using simple OLS and regressions, the replication rates, while definitely higher than with the robust methods, were still far lower than 80%.
Mhm.
And 80% is often seen as a kind of ideal replication rate.
So even the easier tests still had high failure rates.
Yeah. For example, when they maximized microcap influence with equal weighted returns and broader breakpoints, only about 58.6% of anomalies replicated with a single test. And that number plummeted to just 48% when adjusted for multiple testing. Similarly, with OLS regressions, which also heavily weight microcaps, only 58.2% replicated, falling to 48.5% with multiple testing. So this clearly demonstrates that while microcaps certainly explain some of the original exaggerated findings, they absolutely don't account for all the replication failures. Even using methods that give microcaps the most influence, a substantial number of anomalies still fail to hold up, especially once you properly adjust for that multiple testing problem. It signals that it's not just a microcap issue, it's a broader problem of methodological choices and statistical robustness throughout the literature.
Okay, this is where we get really specific then. We've talked about the big picture of failure, the methodological issues, the microcap problem. Now let's dive into those 6 categories of anomalies they examined. Which types of market secrets proved to be mostly, well, fiction, and which ones still seem to offer genuine, reliable insights even after this rigorous scrubbing.
Right. Let's break it down category by category, and we should probably start with the hardest hit, the one they called the biggest casualty. Hashtag tag one. Trading frictions, the biggest casualty.
Okay, the biggest casualty. Here's where it gets really interesting for anyone who thought they could get an edge from sort of market mechanics or liquidity. What happened in this category?
Yeah, this category, which largely focuses on things like liquidity, how easily a stock can be bought or sold, or the volatility of its returns, market microstructure variables, it showed an absolutely astonishing failure rate. Out of 106 anomalies in this category, 102, that's nearly 96%, failed to replicate using their robust NYSE breakpoints and value-weighted returns. 96%.
Wow, almost total wipeout.
Pretty much. And even when they deliberately maximize the influence of microcaps using those older methods, a substantial 60% still failed. So this really means that for serious practical investors, most of these liquidity-based or trading friction-based strategies are highly unreliable.
Can you give some examples of prominent ones that failed?
Sure. Let's take short-term reversal. This is the idea that stocks that recently did very, very poorly tend to bounce back quickly. The original study found a strong effect, like a negative return spread of almost 2% per month. But under the robust replication, it yielded only a tiny, statistically insignificant medical 0.27% per month. The study explicitly concluded this effect was mostly driven by microcaps in the original finding.
Okay, reversal gone. What else?
How about illiquidity, using the popular Amihud measure? This suggests harder-to-trade stocks should offer higher returns as compensation. While some original results looked promising under robust value-weighted sorting, it largely failed to hold up, showing only tiny, mostly insignificant returns. And again, the study pointed to this being mostly driven by microcaps in the original work.
So the illiquidity premium seems fragile too, at least in this form.
Very. Then there are volatility anomalies. This includes ideas like low volatility stocks outperforming high volatility ones. The study examined 16 different volatility measures, and a shocking 15 of them showed insignificant returns when robust methods were applied.
15 out of 16.
Yeah. For example, idiosyncratic volatility, that's the part of a stock's risk unique to that specific stock, showed returns less than half of what was originally reported and was statistically insignificant. And what's even more curious here is that even when they tried to boost the microcap influence using the older methods, these low volatility anomalies still didn't revive. The authors called them extremely fragile.
Doesn't sound good for low vol strategies based on these measures.
Not based on these specific ones, no. And then there are liquidity betas. These measure how sensitive a stock's return is to changes in overall market liquidity. The study tested 5 different versions, including prominent ones from Acharya and Peterson and Pastor and Stambo. All 5 earned insignificant average return spreads across all time horizons using the robust methods. And crucially, the study noted that for these liquidity betas, this replication failure has nothing to do with microcaps. This suggests a fundamental weakness in the anomaly concept itself, not just a measurement issue related to small stocks.
So it sounds like many of these liquidity-based strategies that maybe promised quick gains or secret insights into market mechanics are, Well, mostly phantom profits for institutional investors or anyone trying to apply them in a real-world, scalable way. Those treasure maps for trading friction seem largely blank.
That seems to be the overwhelming conclusion for this category. Yes, hashtag tag 2, intangibles, poor replication.
Okay, what about the next category, intangibles? This sounds like it covers a lot of ground, corporate governance, analyst forecasts, earnings quality. How did these hold up?
This category also showed pretty poor replication rates overall. Only about a quarter of the anomalies in the portfolio sorts, and less than 20% in the regressions, held up under the robust scrutiny using NYSE VW or FMWLS. So another category with widespread failures.
Okay, any prominent examples of things that didn't pan out here?
Yeah, quite a few interesting ones. Take the Corporate Governance Index from Gompers, Ishii, and Metric. This index was supposed to predict returns based on a firm's governance structure. Better governance, better returns, or maybe worse governance, worse returns, depending on the study. The original study found a significant negative alpha, suggesting worse governed firms underperformed by about 0.71% per month. But the replication. It found a tiny, statistically zero average return. Basically, no effect. And what's even more striking is that when they looked outside the original sample period used in that study, this governance index actually showed a positive average return, completely reversing the original finding. This strongly suggests the original result was highly sample-specific and not a durable effect.
Wow, completely flipped. Okay, what else?
How about accrual quality? This is the idea that the quality of a company's non-cash earnings, its accruals, might predict future returns, with higher quality perhaps meaning lower future returns as things revert. The replication found the effect to be small and statistically insignificant. And many other related complex earnings attributes they tested, like earnings persistence or smoothness, also showed small and insignificant returns under robust tests.
So digging deep into the nuances of accounting quality didn't yield much predictive power.
Not in these forms, it seems. Another one, dispersion of analysts' earnings forecasts. The original idea was that stocks where analysts disagreed more about future earnings would tend to underperform. The replication found consistently small returns, very close to zero, effectively disappearing. And again, the study concluded that the effect is mostly driven by microcaps in the original findings.
Seeing a pattern here with microcaps.
Definitely. And another, hiring rate. An anomaly proposed that firms with higher hiring rates would underperform. The replication found some negative return, but it was much smaller than originally reported. This discrepancy was largely attributed to the original study using very restrictive sample screens, which likely biased the result, and surprise, surprise, the anomaly being mostly driven by microcaps. Even widely used financial constraint indices like the Kaplan's and Golly's K-size index and the Weighted Woo WOW index, which try to measure how financially constrained a firm is, showed weak to insignificant results, especially once microcaps were properly accounted for using value-weighting or weighted least squares.
So a lot of these softer, intangible measures seem quite fragile. Were there any exceptions in this category?
There were a couple of nuanced exceptions, yes. Measures related to earnings predictability and earnings timeliness did actually produce statistically significant average return spreads in the replication. So while many of the more complex or governance-related intangibles seem fragile and highly sensitive to measurement and sample choices, some fundamental aspects of earnings information can still offer genuine insight.
Okay, so it seems like even soft data, like corporate governance or analyst forecasts, which sound intuitively like they should offer deep insights, can be really sensitive to exactly how you measure them and which specific stocks you're looking at, with that sensitivity often amplified by those noisy microcaps.
That sums it up pretty well for the intangibles category. Hashtag tag 3, profitability, moderate replication.
All right, let's move on to profitability. This category seems more fundamental how a company's earnings and efficiency relate to its stock returns. How did these anomalies fare?
This category showed, let's say, moderate replication rates. About 44% in the portfolio sorts and 48% in the regressions held up under the robust scrutiny, NYSE EWFMWLS. So definitely better than trading frictions or intangibles, but still a mixed bag. There were some enduring patterns, but also some significant surprises.
Okay, moderate. What are some of the notable findings here?
Well, return on equity, ROE, a classic measure of profitability, generally showed significance, especially within shorter horizons when using value-weighted returns. For example, they found a 0.68% average return spread at the one-month horizon, which broadly reproduced prior findings from Hu, Zhu, and Zhang themselves for that short term.
So basic profitability can work short term. What about more sophisticated measures?
Here's a big surprise. The FAMA and French 2015 operating profitability factor. This is a really widely recognized factor in modern asset pricing models. Surprisingly, it failed to replicate robustly with value-weighted returns in this study. It earned only a small, statistically insignificant return spread. Even after adjusting how it scaled, the estimate remained very low and insignificant.
Wow, that's a big one to fail.
It is. It really suggests that even prominent, well-known factors might be less robust than commonly thought when subjected to these very strict replication standards, especially evaluating. They also looked at two similar profitability measures: gross profits to lagged assets versus gross profits to assets. The second one showed a higher return initially, but the study argued it was actually confounded with the investment premium. Essentially, once you statistically account for the separate effect of how much a company invests, that higher return from gross profits to assets largely disappears, becoming economically small and statistically insignificant.
So you have to be careful not to mix up effects.
Exactly. Another popular one, the Piotrowski 2000 Fundamental Score, or F-score. This combines 9 different accounting criteria to identify fundamentally strong value stocks. The replication found it earned only 0.29% per month using robust methods, significantly lower than the original claim of nearly 2% per month. While some sampling variation played a role, even when they allowed for microcap influence, it barely reached significance. It suggests the original estimate was highly inflated.
Okay, F-score much weaker. What about distress risk? Things predicting bankruptcy.
Yeah, distress anomalies. These include measures like Olson's O-score or Altman's Z-score, designed to predict bankruptcy risk, where riskier firms were sometimes thought to underperform. The study found these effects to be virtually non-existent with value-weighted returns. For example, a widely cited failure probability measure showed insignificant returns in the replicated sample. And interestingly, they found this measure was strongly positive before the original study sample period, but nearly zero after, again highlighting how anomaly effects can be very specific to certain time periods and might not persist.
Right. So profitability can definitely be a factor, but the specific way it's calculated, the metrics used, controlling for other effects like investment, and even the time period can significantly change whether it's a real, exploitable advantage or just a statistical mirage. It's clearly not as simple as profitable companies always do well.
That's a very fair summary. Nuance is key here. Hashtag 4. Investment, acceptable replication.
Okay, how about the investment category? This generally looks at how a company's investment in assets, or maybe its accruals, relates to future stock returns. How did this group fare?
This category showed relatively strong, let's call it acceptable replication rates. Over 73% of the anomalies in both the portfolio sorts and the regressions held up under robust scrutiny. So this category appears significantly more robust overall than trading frictions or intangibles.
Okay, 73% is pretty good compared to the others, but were the returns still smaller than originally reported?
Ah, yes. Even here, where replication was more common, the economic magnitudes, the actual returns, were often significantly lower than the original studies claimed. For example, take investment to assets from Cooper, Gulen, and Schill. This anomaly suggests companies that invest more heavily tend to have lower future returns. The replication found a significant negative return of negative 0.44% per month using robust methods, so the effect is clearly there.
Right.
But it's much lower than the original claims, which ranged from negative 1.05% all the way up to negative 1.73% per month, depending on the method. The study explicitly concluded that overweighting microcaps via equal weighting greatly exaggerates the investment premium in those original findings.
So the effect is real, but maybe half the size originally thought.
Roughly, yeah, in that ballpark. Another example, total accruals from Richardson and colleagues. This is the idea that firms with higher accruals, those non-cash earnings components that eventually have to reverse, tend to underperform. The replication also found a significant negative return here, but it was only negative 0.22% per month. That's a stark contrast to the original study's claim of negative 1.11% per month.
Huge difference again.
Massive. The original study, they noted, suffered from an internal inconsistency in its methodology. But even after trying to correct for that using methods that favored microcaps, the replicated return was still only about half of the original estimate. And it's a similar story for operating accruals, the famous Sloan 1996 anomaly. The replicated return was -0.27% 0.27% per month. Again, significant but much lower than the original Monegat-Rogo 0.87% per month. Sloan also used methods that inadvertently overemphasized microcaps, and even adjusting for that, the effect was only about half the original size.
Okay, so the theme for investment seems to be these anomalies are more consistently reliable than, say, trading frictions. The effect is often real. But even here, the initially reported returns were frequently inflated, largely by methodological choices that overemphasized those tiny microcaps, giving us a misleading picture of their true economic magnitude. The treasure is there, but it's definitely smaller than the original map suggested.
That captures it perfectly. More robust but smaller effects. Hashtag tax, 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 tax 5, value versus growth, moderate replication.
All right, let's turn to a classic, value versus growth. This is a cornerstone of investing, the idea of buying cheap stocks, value, and avoiding expensive ones, growth. How did this fundamental strategy hold up?
Value versus growth showed moderate replication rates, similar to profitability, actually. About 42% in the portfolio sorts and maybe 30% in the regressions held up using the robust value-weighted methods. So this classic strategy clearly has some enduring elements, but there are also some significant issues and specific measures that definitely need revisiting.
Okay, moderate again. What were some of the prominent failures or weaker results here?
Well, one example is 5-year sales growth, used in the famous Lakonishok, Schleifer, and Vishny study. The idea was that companies with high past sales growth stocks, would subsequently underperform. The replication found only a small, statistically insignificant return spread of near 0.19% per month, much smaller than the original Nerva's 0.61%.
What a difference there.
The study suggested both sampling variation, meaning the effect might have been stronger in the specific time period of the original study, and crucially, overweighting microcaps played important roles in that difference. Another interesting failure was long-term analyst forecasts from Laporta's work. This anomaly suggested that stocks with higher long-term earnings growth forecasts made by analysts would paradoxically underperform. The replication found a tiny, insignificant 0.13% per month return spread, which the authors state differs dramatically from the original's whopping minus 1.74% per month.
Minus 1.74%. That's huge. Why did it disappear?
One potential reason cited in the literature and mentioned by the authors is possible large-scale and non-random revisions to the underlying analyst forecast database, IBES, over time. Data quality can be a real issue. The study basically found that this specific anomaly fails to predict returns regardless of sorting frequency, breakpoints, and return weights when using the latest available data. It just doesn't seem to work anymore.
So data issues can kill an anomaly too. Were there positive findings for value?
Yes, absolutely. On a more positive note, the study did reaffirm that using more updated market equity information, as highlighted by Asnes and Frazzini, generally strengthens the predictive power of various value versus growth variables.
Meaning, using the most current stock prices to calculate your value ratios, like price to earnings or price to book.
Exactly. Using more timely market prices seems to lead to more robust results. For instance, they found that monthly sorted portfolios based on things like earnings to price, cash flow to price, or sales to price showed higher return magnitudes than annually sorted ones, especially at the shorter one-month horizon.
Okay, so value investing as a broad concept still seems to hold merit. But it's definitely not a set it and forget it kind of truth. Some of its specific historical measures need careful reevaluation, perhaps due to data quality issues or that recurring microcap influence. It sounds like being smart and precise about how you define and measure value is critical.
I think that's exactly right. The devil is in the details with value measures. Hashtag tag 6. Momentum, acceptable replication.
Okay, last category, momentum. This is the idea that stocks that have performed well recently tend to keep performing well, and vice versa, basically, following trends. How did this popular strategy fare?
Momentum showed acceptable replication rates, quite similar to the investment category, actually. About 63% in the portfolio sorts and 56% in the regressions held up under the robust value-weighted scrutiny. So this strategy proved to be one of the more robust and enduring phenomena in their analysis.
Acceptable. Okay, so better than value or profitability, maybe on par with investment. But again, I have to ask, were the returns smaller than originally claimed?
Yes. Even here in this relatively robust category, the reported returns were often lower than what the initial study suggested. For instance, take earnings surprise from Chan, Jagadish, and Lakonishuk. This suggests stocks with surprisingly good earnings tend to keep doing well. The replication showed significant positive returns, confirming the effect, but these returns were noticeably lower than the original estimates, and the study again found that overweighting microcaps via equal weighting partially explains the differences.
Okay, earnings momentum holds, but maybe less potent. What about other momentum types?
Abnormal returns around earnings announcements. Similar idea, looking at the stock price jump right around the earnings release. This also showed significant positive returns in the replication, but again, the estimates were smaller than the original reported figures, particularly for longer holding periods. Then there's the classic price momentum from Jagadish and Titman looking purely at past price performance, typically over the prior 6 to 12 months. The study found a robust, significant positive return here too, confirming basic price momentum. But the magnitude, using robust methods, around 0.82% per month for a 6-month strategy, was smaller than the original finding, around 1.1%.
So price momentum is real, but maybe not quite the powerhouse it was originally painted as.
It's still significant, but yes, the magnitude seems lower with robust methods. They also showed that while the original estimate could be reproduced if you use the microcap-heavy methods, the effects significantly fell when the sample was extended using their preferred robust techniques. One more interesting one, customer momentum, from Cohen and Frazzini. This is the intriguing idea that if a company's major customers are doing well, showing momentum, the company itself might also perform well soon after. The replication found a significant positive return for this, confirming the link, but the estimate of 0.78% per month was substantially lower than their estimate of 1.58%.
Almost half. Why was that one so different?
The main reason, the study concluded, arose from the original paper's use of a $5 price screen, which tends to exclude the very smallest stocks but can still include many microcaps, likely inflating the reported return compared to the more rigorous value-weighted approach.
Okay, so wrapping up momentum. It seems this strategy, broadly about following trends, whether in price or earnings, largely holds up as a genuine market phenomenon. It's one of the more robust categories. But even here, the actual returns one might realistically expect are considerably less than initially thought, and some of the original procedures clearly inflated the figures. It's still a treasure, perhaps, but maybe not the overflowing pot of gold some maps depicted.
That's a very accurate summary. Momentum survives, but with caveats on magnitude and measurement. #, commonality among replicated anomalies.
This has been a fascinating journey through the wreckage and the survivors, revealing so much nuance about what works and what doesn't. Did the study find any overarching themes or structures within the anomalies that did manage to replicate? Are they just a collection of isolated incidents? Or do they perhaps hint at deeper, more fundamental market forces at play?
Yeah, that's a crucial next question, right? Moving beyond just listing individual anomalies to understanding how they connect or if they connect, it's incredibly important for anyone trying to build robust, maybe simpler investment models. So the study did explore this commonality among the 158 anomalies that replicated successfully using their preferred robust methods. And they found something really interesting. Their initial economic groupings, remember how they categorized anomalies based on concepts like momentum, value, investment, profitability? Well, those initial groupings turned out to be largely consistent with after-the-fact statistical patterns. This means that anomalies within a specific category, like all the different value measures, tended to behave similarly statistically. They likely tap into similar underlying economic drivers.
So the labels they put on them beforehand actually matched how they behaved in the data.
Largely, yes. It's like finding that all the maps you labeled mountain treasures consistently lead to high altitudes, while the ones labeled river treasures lead down to valleys. The economic intuitions seem to align with the statistical clustering. They used correlation analysis to quantify this. Within each category, the correlations between the different anomaly returns were generally quite large. For example, within the value versus growth category, the average correlation between the returns of different successful value strategies was around 0.6. That's pretty high.
Meaning different ways of measuring value tend to move together.
Exactly. It confirms they're likely capturing a similar underlying economic factor or risk. In contrast, the cross-category correlations were generally small. Between, say, value versus growth and investment anomalies, the correlations were quite low, maybe only 0.1 or 0.2. This suggests they are relatively distinct phenomena, likely driven by different underlying economic forces.
Okay, so value is value, investment is investment, and they don't overlap that much.
Broadly speaking, yes. There was one interesting exception: the intangibles category. The few anomalies that survived there had surprisingly low within-category correlations. This suggests it's a more diffused category, maybe just a collection of diverse, unrelated anomalies that happen to fall under that broad intangibles umbrella, rather than representing one single underlying factor. They also use a technique called principal component analysis. PCA. This is a statistical method that helps identify underlying unobserved factors that might explain the common patterns in the data.
Right, finding the hidden drivers.
Yeah. And they found that a single dominant principal component or factor for each category explained a large amount of the total variance of returns within that category. For momentum, one factor explained over 53% of the variance. For value versus growth, almost 60%. For profitability, 55%.
Wow, so one main flavor explains most of the variation within each group.
Pretty much. This is a significant finding. It means that while there might be dozens of different ways to measure momentum, for example, they often share one primary underlying driver. This could really simplify our understanding of market behavior. It suggests that maybe a few core economic forces might explain a large portion of these replicable phenomena, rather than needing hundreds of different explanations for hundreds of disconnected patterns.
That's really interesting. So even the survivors aren't completely independent. They often tap into similar underlying economic forces, which could, yeah, simplify our understanding and potentially lead to more robust, perhaps more consolidated investment factors in the future. It's like discovering that many small streams you were tracking are actually fed by just a few powerful rivers.
That's a great analogy for it, yes. Commonality is key. Hashtag tag implications and takeaways.
Okay, this has been a truly deep dive. We've peeled back layers of assumptions, looked at hundreds of studies, revealed some pretty profound insights into the real predictability or lack thereof in financial markets. What are the big takeaways here for our listener, whether they're an academic researcher, a seasoned investor, or just someone who wants to be better informed about how markets truly work?
Yeah, if we try to connect all this back to the bigger picture, the implications are indeed significant. They really touch on how we view market efficiency and, importantly, how financial research should probably be conducted going forward. I think the most prominent takeaway, the headline really, is that capital markets appear to be far more efficient than previously recognized. The sheer weight of evidence here showing that most published anomalies fail to replicate under rigorous scrutiny, and even the ones that do replicate have much smaller economic magnitudes, strongly suggest that the low-hanging fruit, those easy, exploitable profits, are much, much scarcer than the academic literature might have once implied. The market seems to be a tougher nut to crack than many believed.
So the beat the market secrets are mostly myths, or at least much less powerful.
For the most part, yes, especially the easily discoverable ones based purely on historical data patterns. The second big takeaway is that it's crystal clear that not all anomalies are created equal. We now have a much clearer distinction between genuinely robust findings and those that are, well, fragile, robust anomalies. Things related to value, momentum, investment, and profitability generally replicate well, according to this study. And crucially, they point out that most of these anomalies reside in value-weighted returns, which account for 97% of the aggregate market capitalization. This means they are genuinely relevant and practically applicable for large institutional investors and anyone dealing with significant capital. They represent broad market behavior, not just quirks found in tiny, untradable stocks, fragile anomalies. On the other hand, most of those trading frictions variables, even when trying to maximize microcap influence, showed very high failure rates. Many intangibles anomalies also proved to be highly unreliable. The study concludes pretty emphatically from this that economic fundamentals are more important than trading frictions and driving the cross-section of expected returns.
Meaning, understanding the core business is better than trying to game market mechanics.
In general, yes. Understanding a company's value, its growth prospects, its profitability, its investment policies, these seem to provide more durable insights than trying to exploit fleeting technical patterns or perceived liquidity advantages.
Okay, that makes intuitive sense. What else?
Third, there's a really strong advocacy for using robust procedures in future research. The study powerfully recommends using those NYSE breakpoints and value-weighted returns in portfolio sorts and cross-sectional regressions with weighted least squares. They're not saying the alternative, older procedures are technically wrong in a purely statistical sense, but they argue convincingly that those methods can lead to very fragile, if not misleading, results because of that distorting influence of microcaps. The message is clear. Empirical results from economically more important and statistically more reliable procedures are more credible. This is really a call to action for researchers and maybe for users of research to demand methods that better reflect the economic reality of investable markets.
Right, demand higher standards for evidence.
Exactly. And finally, a point that's crucial for the future health of financial research is recognizing the indispensable role of economic theory. This raises that important question. How do we avoid repeating these mistakes, finding all these fragile results in the future? The study argues, and I think many would agree, that the credibility of the anomalies literature can significantly improve via a closer connection with economic theory. Theory provides a priori predictions, it suggests why something should happen before you even look at the data. This increases the ratio of potentially true relationships you're testing compared to purely random or spurious ones you might stumble upon, as Iwanitis noted.
So theory acts as a filter, guiding the search.
Precisely. Researchers like Harvey, Liu, and Zhu further argue that a factor or anomaly derived from solid theory should arguably have a lower statistical hurdle for significance than one that's purely empirical, just pulled from the data, because it already has a logical foundation. Now, theory isn't always perfect. Of course, researchers can sometimes develop hypotheses after seeing the results, a problem called art king, hypothesizing after results are known. But the study suggests that overall, more applied studies grounded on first principles are likely to increase the credibility of the anomalies literature, moving it beyond just statistical pattern recognition towards genuine economic understanding.
That's a powerful and yet truly essential conclusion for anyone trying to navigate the financial world, whether producing research or consuming it. We've seen today that many of the supposed shortcuts to beating the market might be more mirage than reality, especially when the harsh light of rigorous, real-world replication is shined upon them. The market is definitely a complex beast, but it appears to be a smarter, more efficient one than many researchers perhaps initially gave it credit for. So what does all this mean for you, our curious listener, maybe a potential investor? Well, next time you hear about a new market anomaly, some hidden trick, or a guaranteed way to predict stock movements, maybe pause and consider not just what is being claimed, but how it was found. Was the claim based on those tiny, numerous, virtually untradeable stocks? Was the methodology transparent and robust? Did it favor economically significant value-weighted measures that reflect how real money actually moves in the market? Perhaps true market wisdom isn't about constantly finding new, fleeting statistical curiosities, but rather focusing on understanding the fundamental, durable economic drivers that genuinely create and move value over the long term, instead of chasing patterns that seem to disappear under scrutiny. This deep dive into replication doesn't just reshape our understanding of market efficiency. It really challenges all of us to demand more rigor, more robustness from the information that guides our financial decisions. And hopefully that makes us more discerning and ultimately more successful in our financial journeys.